Welcome to Markets Plus, where leading experts from across BMO discuss factors shaping the markets, economy, industry sectors, and much more. Visit bmocm.com/Markets Plus for more episodes. The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries.
Welcome to Markets Plus, where we cover the latest market, economic, and business trends. I'm Laurence Mutkin, Head of EMEA Rates Strategy at BMO. Today, I'd like to introduce the latest episode in our series of podcasts called BMO EMEA Perspectives. This one is entitled UK Spring Statement, Stability and Innovation. The stability comes from gross gilt issuance, which at 299 billion was near our forecast and near last year's level, and at the comfortable end of market expectations. The innovation comes from the Debt Management Office remit, which was innovative in two ways. First, it reduced the duration of issuance by even more than the market expected. And second, it introduced programmatic gilt tenders, which are scheduled taps of off-the-run bonds. Other features of the spring statement were its monetary policy implications, which were maybe slightly positive at the margin, and its implication for fiscal sustainability, which we think is, broadly speaking, good enough for the market. Just to say, we would like to keep these podcasts as interactive as possible. So please do submit questions or comments by emailing me at laurence.mutkin@bmo.com. That's laurence.mutkin@bmo.com. Or you can find me on Bloomberg. Your feedback is valued. Please don't hesitate to reach out with any topics you'd like to hear about on future episodes. And now, on to the detail of this episode. We went into the spring statement and the 2025-26 DMO remit looking for four elements to drive the reaction of the gilt market and the pound. Gilt issuance in 2025-26, the shape of the remit, the impact on the outlook for monetary policy, and fiscal sustainability. So here are the highlights regarding each of these. First, gilt issuance. Issuance for 2025-26 came out at £299 billion, which was just £7 billion higher than we had expected, little different from last year, and at the comfortable end of market expectations. It could be revised up by a few billions after the publication of the final PSMB of the financial year. Although quite low relative to the worst fears of the market, this level of issuance remains extremely high by historical standards, and the number of gilts which the private sector will need to absorb in 25-26 as a percentage of GDP will again be higher even than during the global financial crisis, as it was this year. And the outlook over a long time frame has also deteriorated. So gross gilt issuance has been revised higher for every one of the next 5 years of the forecast. All in all, therefore, it could have been worse in terms of gross issuance for this year, but the overall picture still is challenging. Number two is the DMO's issuance remit, and there are two innovations here. First, the DMO decided to shorten duration and increase flexibility. The remit's reduction in long-duration issuance surpassed market expectations, at least superficially. Both in percentage terms and in absolute terms, long-end issuance fell, and the planned percentage of short plus mediums is the highest this century at 67% of total issuance. Having said that, the reduction in long issuance may be something of a chimera, as unallocated issuance has been increased by a very similar proportion to the reduction in longs, and it may be that a lot of it ends up as long issuance anyway. But at least this reweighting between categories gives the market comfort that the DMO is not set on a course which would mean selling lots of long duration, whether the market wants it or not. The second innovation is what the DMO is calling the introduction of programmatic gilt tenders. These are scheduled taps of off-the-run bonds. This is happening for the first time, apparently at the rate of about one a month, and they can be used to reopen any off-the-run bond. The introduction of this program is a response to the phenomenon that as gilt yields have risen since the end of QE, the gilt yield curve has become, if you like, more jagged, less smooth. There are good reasons for this. The tax treatment of coupon income versus capital gains is one. The different levels of free float of each issue is another. But the upshot is that the spread of individual gilt yields versus a fitted curve has, on average, become more dispersed. And in this respect, the UK looks a lot more jagged as a yield curve than its other sovereign peers. The DMO presumably hopes that the introduction of this program will do two things. First, it will tap a bond-specific source of demand, which didn't exist during QE when the curve was smooth. And secondly, it may alleviate some of those distortions in the gilt curve, which are due to supply-demand imbalances. Unsurprisingly, the market reaction has been to cheapen some of those off-the-run issues, which have tended to trade expensively to the curve, notably those with very low coupons and those with a smaller free float. The third aspect of what we would like to look at is the impact on the outlook for monetary policy. Now, the Office of Budget Responsibility, the OBR, did some forecasts which managed to create a rather gilt-friendly economic outlook. The OBR is now forecasting a negative output gap, i.e. excess capacity, during 2025 and 2026 due to downward revisions in near-term GDP growth. And that negative output gap allows it to forecast that inflation will make a swift return to the 2% target at the 2-year horizon, which is, of course, the Bank of England's so-called policy-relevant horizon. And it, meanwhile, manages to forecast an acceleration in GDP and potential GDP over the medium term due to benefits it thinks the economy will get from the reform of residential planning law. And that, of course, implies better debt sustainability. That would seem to be a happy outcome of various revisions from the OBR. But interestingly, if the Bank of England's next quarterly forecast were to incorporate a similar outlook to the OBR, then the result would, we think, be quite supportive for gilts, because it would imply both the persistence of inflation would diminish and the speed limit for the economy would be quicker. Therefore, the Bank of England could continue to cut the policy rate in the near term and could be less quick to raise rates in response to economic acceleration over the medium term. And all that should be good for gilts. But we don't want to get too optimistic about it for three reasons. First, historically, the bank's forecast and the OBR's forecast for growth and inflation have not been particularly close. Secondly, because the Bank of England is a policymaker, whereas the OBR is only a watchdog, the bank's anti-inflation credibility is more important than the OBR's. And it's already been stretched by the re-acceleration of inflation this year, a situation which will only intensify later. So the bank's risk profile is different to the OBR's, and that may lead it to stay its hand more than it might otherwise in cutting rates. And lastly, the market is already pricing in that the bank is going to reach a terminal rate in this policy cycle of around 4%. And that, at 200 basis points above the inflation targets, is already quite low by historical standards, by which I mean the standards which prevailed before quantitative easing. Likewise, if you compare the 10-year gilt yield to that period, they're not obviously cheap either. The fourth and final issue that I said the market would look at when we got the spring statement is fiscal sustainability. The first question is Chancellor Reeves going to still meet her fiscal rules? And the answer is, as it always would be, yes, she is, because it's to meet those fiscal rules that she took the measures that she took. So the OBR's trajectory for the debt to GDP ratio is stable throughout the forecast at about 105% of GDP. And that's actually a little bit better than October's forecast. It may be that the market doesn't believe the OBR is right to be so optimistic on growth, but even if it's supposed to be a bit less optimistic on growth, I think around 105% with the shallow trajectory is good enough for the market. Less good is the trajectory for gross financing in future and gilt issuance. Due to higher forecasts now for both deficits and redemptions, issuance is going to stay higher for longer, according to the OBR. Although this may become a concern in the future, I think for now, the market is happy to take fiscal sustainability 1 year at a time. So that's what came out altogether from the spring statement and the Debt Management Office's remit. So let me just briefly talk about what our recommendations are that come out of this event. The market's reaction to the spring statement initially was pretty muted. And that makes sense to us because there was quite a big sell-off in gilts last week, which we think appropriately repriced some of the risks we have been worrying about. The biggest response on the day was at the long end of the yield curve, where 10s, 30s flattened in response to the relative reduction in long issuance, which, as we said, was rather bigger than the market was looking for. In our view, the risks around the terminal rate for the Bank of England's policy cycle, as represented by the two-year forward, are now pretty symmetrical around 4%. So we don't really have a recommendation in that part of the yield curve. However, we continue to see the risks to the 10-year yield as being skewed to the upside over the near term, given long-term valuation metrics and the continuing prospect of high overall issuance this year and beyond. Now that the spring statement risk event has passed, therefore, we recommend going neutral of two-year rates and staying short 10-year gilts, targeting 4.9%. On the yield curve, our recommendations to pay the belly of 5s, 10s, 30s in swaps, both outright and versus the US, naturally perform well as 10s, 30s have flattened. But we think that both the outright and the cross-market trade still have further to go. In swap spreads, now this risk event is out of the way, we recommend re-entering long gilt on asset swap in 0 to 10 years. Thank you.
Thanks for listening. You can follow this podcast on Apple Podcasts, Spotify, or your favorite podcast app. For more episodes, visit bmocm.com/marketsplus. The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.